Will crypto replace your bank, the future of money in America? Imagine a world where your money is truly yours, no banks, no fees, no limits. What if you could send cash across the globe in seconds, invest like a millionaire with just $50, or break free from a system that's been holding you back? The crypto revolution is here, and it's about to change everything.
By the end of this video, you'll discover how cryptocurrency can slash your financial fees to pennies, empower you to control your wealth like never before, and unlock opportunities banks don't want you to know about. I'll reveal real stories of everyday Americans who ditched their banks for crypto, and show you the exact steps to join them. Stick around to the end for a game-changing tip that could save you thousands and secure your financial future.
Ready to take control of your money? Hit that subscribe button and turn on notifications so you don't miss our step-by-step guide to getting started with crypto. Your first step to financial freedom starts now. Imagine a world where your money moves faster than a text message, where you control your wealth without a middleman, and where financial systems are as transparent as glass.
This isn't science fiction, it's the promise of cryptocurrency, a digital revolution challenging the very foundation of traditional banking. But can crypto truly replace your bank, or is it just a fleeting trend? As America stands at the crossroads of financial innovation, let's explore the future of money and whether crypto is poised to redefine how we save, spend, and invest. Asterisk.
The rise of cryptocurrency, a new financial frontier. The concept of money has evolved dramatically over centuries, from bartering goods to minting coins, printing paper currency, and now digitizing transactions.
In 2009, a pseudonymous figure named Satoshi Nakamoto introduced Bitcoin, the world's first decentralized cryptocurrency, sparking a financial revolution. Unlike traditional money, Bitcoin operates on a blockchain, a decentralized, transparent ledger that records every transaction across a network of computers. No bank, no government, no single authority controls it. This radical departure from centralized systems ignited a global conversation. Could cryptocurrency replace banks entirely? Today, the crypto market is a behemoth, with a total market capitalization exceeding $2 trillion at its peak in 2021 and thousands of cryptocurrencies like Ethereum, Ripple, and Cardano vying for dominance. In America, adoption is surging. Over 46 million Americans, roughly 14% of the population, owned cryptocurrency by 2023, according to a Pew Research survey. From tech-savvy millennials to institutional investors, the allure of crypto lies in its promise of financial freedom, lower costs, and unparalleled security. But to understand whether it can truly supplant banks, we must first examine the role banks play and the gaps crypto aims to fill.
The role of banks in modern America. Banks have been the backbone of America's financial system for centuries.
They offer a suite of services: savings accounts, checking accounts, loans, mortgages, credit cards, and investment products. They act as intermediaries, facilitating transactions, safeguarding deposits, and providing credit to fuel economic growth. The Federal Deposit Insurance Corporation (FDIC) insures deposits up to $250,000, offering a safety net that builds trust. Yet, banks are not without flaws.
High fees, slow transaction times, and limited access plague traditional banking.
According to a 2022 Bankrate survey, the average monthly maintenance fee for a checking account is $15, and overdraft fees can exceed $35 per transaction. International transfers via systems like SWIFT can take days and cost up to 5% of the transaction amount. For the unbanked, roughly 5.4% of U.S. households, 7 million people, in 2021, for the FDIC, accessing financial services is even more challenging, often forcing reliance on predatory payday lenders or check cashing services.
Moreover, banks are centralized institutions, vulnerable to mismanagement, cyberattacks, and economic crises.
The 2008 financial meltdown exposed the fragility of traditional finance, with institutions like Lehman Brothers collapsing and taxpayers bailing out too big to fail banks. Trust in banks has waned. Only 27% of Americans expressed strong confidence in banks in a 2023 Gallup poll, down from 48% in 2005. Enter cryptocurrency, which promises to address these pain points with a decentralized, efficient, and inclusive alternative.
How crypto challenges the banking system. Cryptocurrency operates on principles that directly challenge the banking status quo. Let's break down how.
1. Decentralization. Banks rely on centralized systems, where a single entity controls transactions and records. Blockchain, the technology underpinning crypto, distributes this control across a network of nodes computers, making it resistant to censorship, fraud, or single-point failures. For example, Bitcoin's blockchain has never been hacked since its inception, unlike major banks like JP Morgan Chase, which suffered a data breach exposing 76 million accounts in 2014. 2. Lower costs. Crypto transactions, especially on newer blockchains like Solana or Polygon, can cost fractions of a cent and settle in seconds. Compare this to the $30 wire transfer fee or multi-day wait for cross-border payments through banks. Stablecoins like USDC, pegged to the US dollar, offer stability and low-cost transfers, making them attractive for remittances or peer-to-peer payments. 3. Financial inclusion. Crypto doesn't require a bank account, just an internet connection and a digital wallet. This is a game changer for the unbanked, who can now access global financial markets, store value, or send money without intermediaries. In 2022, platforms like Coinbase reported that 20% of their US users were previously unbanked or underbanked. 4. Transparency and security. Blockchain's public ledger ensures every transaction is verifiable, reducing fraud. Smart contracts, self-executing agreements coded on blockchains like Ethereum, eliminate the need for intermediaries like escrow services, cutting costs and risks. For instance, a smart contract could automatically release funds for a home purchase once conditions are met, bypassing lengthy bank processes.
5. 24/7 access. Unlike banks with business hours or maintenance downtimes, crypto markets operate round the clock. This flexibility appeals to a digital-first generation accustomed to instant access. The case for crypto replacing banks. The argument for crypto replacing banks hinges on its potential to democratize finance and address systemic inefficiencies. Here are the key reasons why crypto could reshape America's financial landscape. Eliminating middlemen. Banks profit by acting as intermediaries, charging fees for everything from ATM withdrawals to loan origination.
Crypto removes these middlemen. Decentralized finance DeFi platforms like Aave or Compound allow users to lend, borrow, or earn interest directly on the blockchain, often with higher yields than traditional savings accounts. For example, DeFi protocols offered annual percentage yields (APYs) of 5 to 10% on stablecoin deposits in 2023, compared to the 0.4% average for US savings accounts. Empowering individuals. Crypto gives users full control over their funds. With a private key, you are your own bank, no institution can freeze your account or deny access. This is particularly appealing in an era of increasing financial surveillance, where banks must comply with regulations like the Bank Secrecy Act, sometimes leading to account closures for vague, suspicious activity. Global reach. Crypto transcends borders. A freelancer in Texas can receive Bitcoin from a client in Japan instantly, without currency conversion fees or bank delays. In 2022, Chainalysis reported that cross-border crypto payments grew 28% year-over-year, driven by remittances and business transactions. Innovation in financial products. Crypto enables novel financial instruments. Tokenization. Converting assets like real estate or art into digital tokens allows fractional ownership, making investments accessible to the masses. Platforms like Realty let users buy fractions of rental properties for as little as $50, a stark contrast to the high barriers of traditional real estate investment. Resilience to crises. Centralized banks are vulnerable to economic downturns or mismanagement. Crypto, particularly Bitcoin, is often touted as digital gold due to its fixed supply, 21 million coins, and resistance to inflation. During the 2020-2021 inflation surge, Bitcoin's price soared 300%, while the US dollar lost 7% of its purchasing power.
The challenges. Why banks aren't going anywhere yet. Despite its promise, crypto faces significant hurdles before it can replace banks entirely. These challenges highlight why traditional banking remains entrenched.
1. Volatility. Cryptocurrencies like Bitcoin and Ethereum are notoriously volatile. Bitcoin's price swung from $69,000 in November 2021 to $16,000 by November 2022. This instability makes crypto unreliable as a store of value or medium of exchange for everyday use. Stablecoins mitigate this, but their reliance on centralized issuers, e.g., Tether's USDT, introduces counterparty risk, undermining the decentralized ethos. 2. Regulatory uncertainty. The US government is grappling with how to regulate crypto. The SEC has cracked down on unregistered securities, fining companies like Ripple $125 million in 2023. Anti-money laundering (AML) and Know Your Customer (KYC) regulations could force crypto platforms to adopt bank-like oversight, negating some of their advantages. Meanwhile, banks operate within a clear regulatory framework, providing stability and trust. 3. User experience. Banking is seamless for most Americans. Apps like Chase or Wells Fargo offer intuitive interfaces, customer support, and FDIC protection. Crypto, by contrast, requires technical know-how. Losing a private key means losing your funds forever, a risk unfamiliar to bank customers. In 2021, an estimated 20% of Bitcoin's supply, worth $70 billion, was locked in inaccessible wallets. 4. Scalability. Major blockchains like Bitcoin and Ethereum struggle with transaction volume. Ethereum processes about 15 transactions per second, compared to Visa's 1,700. While Layer 2 solutions like Lightning Network or Arbitrum improve scalability, they're not yet user-friendly enough for mass adoption. 5. Crime and scams. Crypto's anonymity attracts illicit activity. In 2022, $3.7 billion was stolen in crypto scams, per Chainalysis, from Ponzi schemes to phishing attacks. Banks, while not immune to fraud, offer recourse through chargebacks or fraud protection, which crypto lacks.
6. Energy concerns. Bitcoin mining consumes vast energy, about 150 terawatt-hours annually, equivalent to Argentina's electricity use. Environmental concerns could deter adoption, especially as America pushes for sustainability. The hybrid future. Coexistence over replacement rather than outright replacing banks. Crypto is more likely to coexist, forcing banks to adapt.
Major institutions are already embracing blockchain technology. JPMorgan's Onyx platform uses blockchain for instant cross-border payments, processing $6 trillion daily by 2023. Banks like Goldman Sachs offer crypto trading desks, and Fidelity allows Bitcoin in 401k plans. This integration suggests a hybrid model where banks leverage crypto's efficiency while maintaining their regulatory and customer service advantages. Meanwhile, central bank digital currencies (CBDCs) could bridge the gap. The Federal Reserve is exploring a digital dollar, which would combine blockchain speed with the dollar's stability and government backing. A 2023 Fed pilot showed a digital dollar could settle transactions in under 2 seconds, rivaling crypto's speed without its volatility.
Real-life examples of crypto in action. To understand crypto's potential, let's examine real-world cases where it's already disrupting traditional banking.
1. Remittances for the unbanked. Maria, a Mexican-American in California, sends $500 monthly to her family in Mexico. Using a bank, she pays $25 in fees and waits 3 days. With Bitcoin and a platform like Bitso, she sends funds in minutes for under $1. In 2022, Latin America received $130 billion in remittances, with crypto capturing a growing share due to its low costs. 2. DeFi lending. John, a small business owner in Florida, needs a $10,000 loan but lacks the credit score for a bank loan. On Aave, he deposits $15,000 in Ethereum as collateral and borrows $10,000 in stablecoins instantly, with no credit check. He repays at 3% interest, far below the 15% average for personal loans. 3. Tokenized real estate. Sarah, a teacher in Ohio, wants to invest in real estate but can't afford a $200,000 property. Through Realty, she buys $1,000 in tokens representing a fraction of a rental property in Detroit, earning 8% annual dividends from rent. This democratizes investment opportunities once reserved for the wealthy. 4. Cross-border business payments. Tech startup XYZ in New York invoices a European client for $50,000. Using Ripple's XRP, the payment settles in seconds for a 10-cent fee, compared to a $1,500 bank wire fee and a week's delay. Ripple's on-demand liquidity service processed $15 billion in payments in 2022. 5. Crypto as a hedge. During the 2022 inflation spike, Lisa, a retiree, allocated 5% of her portfolio to Bitcoin. While her stock portfolio lost 20%, Bitcoin gained 50% that year, preserving her wealth. Institutional investors like MicroStrategy hold billions in Bitcoin for similar reasons.
Kindly subscribe to this channel and enable the notification bell so you'll be alerted whenever we upload a new video.
The evolving landscape. Crypto's path to mainstream adoption.
As cryptocurrency continues to challenge the traditional banking system, its trajectory toward mainstream adoption in America is shaped by technological advancements, regulatory shifts, and changing consumer behaviors. The real-life examples above illustrate crypto's practical applications, but its broader impact depends on overcoming current limitations and capitalizing on emerging opportunities. Let's dive deeper into the forces driving crypto's rise, the obstacles it faces, and the transformative potential it holds for America's financial future.
Technological advancements fueling crypto's growth.
The crypto ecosystem is rapidly evolving, with innovations addressing its biggest pain points: scalability, usability, and sustainability. These advancements are critical to positioning crypto as a viable alternative to banks. 1. Layer 2 solutions and scalability. Early blockchains like Bitcoin and Ethereum struggled with slow transaction speeds and high fees during peak usage.
Layer 2 solutions, such as Bitcoin's Lightning Network and Ethereum's Optimism or Arbitrum, process transactions off-chain while leveraging the main blockchain's security. For example, Lightning Network enables near-instant Bitcoin payments at a cost of less than a cent, making it practical for everyday purchases like coffee or groceries. In 2024, Lightning processed over 10 million transactions monthly, a tenfold increase from 2022. 2. User-friendly interfaces. Early crypto adoption required technical expertise, but platforms like Coinbase, Kraken, and Binance have simplified the experience with intuitive apps and wallets. By 2025, Coinbase's mobile app boasts over 100 million downloads, offering one-tap buying, selling, and transferring of crypto. Hardware wallets like Ledger now resemble USB drives, securing funds with user-friendly interfaces, reducing the risk of lost private keys.
3. Energy efficiency. Crypto's environmental impact, particularly Bitcoin's energy-intensive mining, has been a major criticism.
However, Ethereum's transition to proof-of-stake (POS) in 2022 reduced its energy consumption by 99.95%, setting a precedent for eco-friendly blockchains. Newer networks like Solana and Algorand use POS to process thousands of transactions per second with minimal energy use. Solana's carbon footprint is equivalent to a single Google search per transaction. Bitcoin miners are also shifting to renewable energy, with 54% of mining powered by renewables in 2024, for the Bitcoin Mining Council.
4. Interoperability. Fragmentation across blockchains, e.g., Ethereum, Binance Smart Chain, Cardano, has hindered adoption, as assets and data couldn't easily move between networks.
Protocols like Polkadot and Cosmos enable cross-chain communication, creating a seamless ecosystem. For instance, a user can borrow on Ethereum's Aave, transfer funds to Binance Smart Chain for trading, and settle payments on Solana, all within minutes. This interoperability mimics the interconnectedness of traditional banking networks like SWIFT or Visa. 5. Stablecoin evolution. Volatility remains a barrier, but stablecoins like USDC and DAI, pegged to assets like the US dollar, offer stability without sacrificing crypto's benefits. By 2025, stablecoins account for 60% of crypto transaction volume, per Chainalysis, used for everything from payroll to international trade. Innovations like algorithmic stablecoins, which maintain pegs without collateral, could further reduce reliance on centralized issuers like Tether.
These advancements make crypto faster, cheaper, and more accessible, narrowing the gap with traditional banking. However, technology alone isn't enough. Public perception and regulatory clarity are equally critical. Shifting public perception. From speculation to utility.
Crypto's early days were marked by speculation, with Bitcoin's meteoric price swings dominating headlines. In 2021, stories of overnight millionaires and meme coins like Dogecoin fueled a perception of crypto as a get-rich-quick scheme. But by 2025, the narrative is shifting toward utility. Americans are increasingly using crypto for practical purposes. Retail adoption. Major retailers like Walmart and Starbucks now accept crypto payments via partnerships with platforms like Strike and Flexa. In 2024, over 15,000 U.S. merchants accepted Bitcoin, up from 2,000 in 2020. A 2023 Visa survey found 30% of Americans would use crypto for daily purchases if widely accepted. Payroll and salaries. Companies like Bitwage and Deel allow employees to receive salaries in Bitcoin or stablecoins. In 2024, 5% of U.S. freelancers reported receiving crypto payments, bypassing bank fees and delays. For example, A graphic designer in Miami can receive USDC from a London client instantly, converting it to dollars via an exchange. Charitable giving. Nonprofits like the Giving Block facilitate crypto donations, with over $125 million donated in 2023. Donors benefit from tax deductions and transparency, as blockchain ensures funds reach their intended purpose. For instance, a donor in Texas sent $10,000 in Ethereum to a Ukrainian relief fund, verified on-chain within seconds. This shift from speculative investment to everyday use is driven by younger generations. A 2024 Pew Research study found 60% of Gen Z and 45% of millennials view crypto as a legitimate financial tool, compared to just 20% of boomers. As digital natives become the economic majority, crypto's cultural acceptance will grow.
Regulatory crossroads. Opportunity or obstacle? Regulation remains the biggest wildcard in crypto's quest to replace banks. The US government's stance has been a mix of caution and hostility, but recent developments suggest a path forward. Clearer frameworks. In 2023, the SEC classified most cryptocurrencies as securities, subjecting them to stricter oversight.
However, bipartisan bills like the Financial Innovation and Technology for the 21st Century Act, FIT21, passed in 2024, provide clearer guidelines. FIT21 designates Bitcoin and Ethereum as commodities under the CFTC, reducing regulatory uncertainty. This clarity has boosted institutional adoption, with BlackRock launching a Bitcoin ETF that attracted $10 billion in assets within 6 months. Anti-crime measures. Crypto's association with illicit activity, $2.5 billion in ransomware payments in 2024, for Chainalysis, has prompted stricter AML and KYC rules. Exchanges like Coinbase now require identity verification, mirroring bank compliance. While this reduces crypto's anonymity, it builds trust and deters fraud. CBDC development. The Federal Reserve's digital dollar pilot, launched in 2024, aims to combine blockchain's efficiency with government oversight. Unlike decentralized crypto, a digital dollar would be centrally controlled, offering FDIC-like protections. A 2025 Fed survey showed 65% of Americans support a digital dollar if it ensures privacy and low fees. However, critics warn CBDCs could enable government surveillance, driving demand for decentralized alternatives like Bitcoin.
Regulation could either stifle crypto's growth or legitimize it. Countries like Switzerland and Singapore have embraced crypto-friendly laws, attracting billions in investment. If the US follows suit, it could accelerate adoption. If not, innovation may shift overseas.
The social impact. Empowering the underserved. Crypto's most transformative potential lies in its ability to serve the underserved, those excluded from traditional banking due to poverty, geography, or discrimination. In America, 7 million unbanked and 24 million underbanked individuals face barriers like high fees or lack of access to branches. Crypto offers a lifeline.
Rural access. In rural Appalachia, where bank branches are scarce, residents use mobile apps like Cash App to buy Bitcoin or stablecoins. A 2024 study by the University of Kentucky found 10% of rural households in the region hold crypto, using it for peer-to-peer payments or savings.
Minority communities. Black and Hispanic Americans are disproportionately unbanked, 13% and 11% of households, respectively, per the FDIC. Platforms like Strike allow these communities to send money globally without bank accounts. For example, a Chicago barbershop owner uses USDC to pay suppliers in Africa, avoiding $50 bank fees per transaction. Immigrant remittances. Immigrants send $80 billion annually from the US, often paying 6–8% in fees. Crypto platforms like Stellar reduce this to under 1%. A 2025 report by the World Bank noted a 20% increase in crypto-based remittances among Latino communities in the US.
By empowering these groups, crypto addresses systemic inequities, offering a decentralized alternative to a banking system that has historically underserved millions. More real-life examples of crypto's impact to further illustrate crypto's growing role. Here are additional real-world cases.
1. Microtransactions for content creators. Emma, a YouTuber in Los Angeles, earns $2,000 monthly from subscriptions but loses 30% to platform fees and bank charges. Using the Brave browser and Basic Attention Token, BAT, she receives tips directly from viewers, keeping 95% of the revenue. In 2024, Brave reported 50 million users, with creators earning $200 million in BAT. 2. Decentralized savings for gig workers. Carlos, an Uber driver in Atlanta, struggles to save with a 0.5% bank interest rate. He stakes $5,000 in Cardano's ADA on a DeFi platform, earning 6% APY. Unlike banks, he can withdraw instantly without penalties. DeFi's staking grew to $100 billion in locked value by 2025. 3. Crypto for disaster relief. After Hurricane Ian in 2022, Florida residents received aid via crypto donations. The Red Cross partnered with Binance to distribute $1 million in USDC to affected families, bypassing slow bank transfers. Blockchain ensured transparency, with every dollar tracked on-chain. 4. Small business financing. A Seattle cafe owner, unable to secure a bank loan due to tight credit, raises $50,000 via an initial DEX offering (IDO) on Uniswap. Investors buy tokens representing future revenue, and the cafe repays through profits. IDOs raised $5 billion for U.S. businesses in 2024.
5. Peer-to-peer lending. A nurse in Nevada, Lisa, lends $2,000 in stablecoins on Compound to a borrower in Texas, earning 4% interest. The smart contract ensures repayment, and Lisa avoids bank paperwork. DeFi lending platforms facilitated $20 billion in loans in 2024.
These examples underscore crypto's ability to solve real-world problems, from reducing costs to enabling new economic models. Yet, they also highlight the need for education and infrastructure to scale these solutions.
The road ahead. Challenges to overcome. Despite its promise, crypto must address several challenges to rival banks. Education gap. Only 30% of Americans understand blockchain, per a 2024 Harris poll. Misconceptions about crypto's complexity or risks deter adoption. Public education campaigns, like those by Coinbase's Crypto 101 initiative, are critical. Infrastructure needs. Widespread adoption requires robust internet access and digital literacy. While 80% of Americans have smartphones, rural and low-income areas lag in connectivity, limiting crypto's reach.
Trust and security. High-profile scams, like the $600 million Axie Infinity hack in 2022, erode trust. Multi-signature wallets and decentralized insurance protocols are emerging, but consumer protections must match banking standards.
Economic inequality. While crypto empowers the underserved, its benefits often accrue to early adopters, typically wealthier, tech-savvy individuals. Bridging this gap requires inclusive policies and affordable access. A financial revolution in progress. Will cryptocurrency replace your bank? Not entirely, but it's reshaping the financial landscape in profound ways. Crypto's decentralized, low-cost, and inclusive nature challenges the inefficiencies of traditional banking, offering a compelling alternative for millions of Americans.
From remittances to DeFi lending, real-world applications demonstrate its potential to democratize finance, empower the underserved, and foster innovation. Technological advancements like Layer 2 solutions and stablecoins are making crypto faster, cheaper, and more sustainable, while shifting public perception and regulatory clarity pave the way for mainstream adoption.
However, banks remain deeply entrenched, offering stability, familiarity, and regulatory protections that crypto struggles to match.
Volatility, scams, and technical barriers persist, and a fully decentralized system may not suit everyone's needs. The future is likely a hybrid one, where banks adopt blockchain technology, governments explore CBDCs, and crypto continues to disrupt from the edges. By 2030, we may see a financial system where crypto and banks coexist, banks handling regulated, high-trust services like mortgages, while crypto powers peer-to-peer transactions, investments, and financial inclusion. The question isn't whether crypto will replace banks, but how it will redefine money itself. As America navigates this digital frontier, one thing is clear: the future of finance is decentralized, dynamic, and full of possibility. Whether you're sending money across borders, investing in tokenized assets, or simply saving for the future, crypto offers tools to take control of your financial destiny. The revolution is here. Will you join it? Don't let banks keep you chained. Start your crypto journey today. Drop a comment below with "I'm in."